There are a few different investing styles, three of the main ones being growth investors, value investors, and income investors. Growth investors focus on identifying companies that they believe are capable of above-average growth in their earnings and profits. There are different types of growth companies, ranging from nascent companies making little or no profit to large and well-diversified companies. Value investors, meanwhile, aim to uncover businesses whose share prices are at a discount to their true worth in the hope that over time, their full value will be realized. A strict value philosophy would mean concentrating specifically on the underlying value of a business rather than aiming to anticipate earnings trends into the future, which could be less predictable. So value investors are naturally contrarian, avoiding fashionable areas and targeting those that are maligned or ignored in search of unappreciated bargains. However, care needs to be taken to avoid value traps, which are companies that appear great value but are actually in terminal decline. What generally distinguishes growth and value is whether shares are cheap or expensive by certain metrics such as the price-to-earnings ratio. This measures just how much investors have to pay up for a certain level of company earnings. So businesses with higher growth rates usually deserve to be more expensive, but the market is constantly evolving. So companies as well as sectors change, becoming more or less profitable. Rather than looking at growth versus value, some investors are looking to generate income, especially with interest rates on cash so low. So you can get an idea of just how much income an investment produces by looking up its yield. Generally, this is the amount of income it has paid over the past year divided by its price, and it is expressed as a percentage. This could be different going forward because the dividend could be higher or it could be lower, plus of course the price might change, but it can give a useful indication of the possible amount on offer. Of the major asset classes available to income investors, shares or equities are appealing because they offer the potential for growing income as profits increase. So although investing in the stock market generally means accepting a greater degree of ups and downs, it offers the greatest potential for growth in both income as well as capital. So shares represent a stake in the business, and as a shareholder, you get to participate in the growth of the business. If it does well, of course, and often you receive a share of the profits through a dividend payment.